BPCL stock has been a non-performer and has eroded close to 20% of investors' wealth this calendar year. In fact, the stock hit its 52-week low mark at around 360 rupees 20 days back on 24th May of 2018. This was despite the fact that the company posted robust Q4 numbers. The fall has mainly been triggered by the possibility that a busy political year will restrict any upside with respect to the retail pricing, impacting the company's marketing margins. Also, the macro worry related to the rising crude prices impacting the gross refining margins of the company remained a key concern. To add to this, a section of investors feared that OMCs might be asked to bear the subsidy burden, and slower than expected rise in refining margins at the expanded capacity at Kochi suggested that expansion there is yet to stabilize and could be one of the reasons for the decline in share price. But of course, there are certain factors that can stimulate reversal in the stock's current performance. Biggest relief came in when government clarified that the daily fuel pricing mechanism will continue and the same will not be regulated. Also, that OMCs will not be asked to share the subsidy burden. And specifically for this particular company, refining margins at the expanded Kochi facility are expected to rise, and analysts, they are expecting it to add around $2 per barrel to the current GRMs. Management on its con call also highlighted that they're expecting an increase in the market share in petrol and diesel. But what are the brokerages saying? They have very mixed views on the stock. CLSA recently increased the target price but still maintains a sell as they see a macro risk in the election year. Jefferies, on the other hand, also maintains an underperform rating and has cut its target price from 425 to 360. However, Morgan Stanley, that particular brokerage, is sanguine on the company and maintains an overweight as they expect robust fuel marketing margins and steady earnings for the company. Edelweiss also remains constructive on the stock as they expect new Kochi capacity to fetch premium GRMs for the company. While macro risks, they are largely the same for all the oil marketing companies, there's still some valuation comfort in BPCL and it trades comparatively cheaper to its peers. This makes it attractive in comparison to the others. Right now, it's trading at an FY19 PE of 7.5 times versus IOC trading at around that 8 times level, and also HPCL trading around that same level right now. But this is a disclaimer that the stock is not a buy recommendation.